Well, India's inclusion in the JP Morgan Global EM Bond Index saw yields fall on Friday, and then bonds gave up some gains. Now, over the weekend, experts have done their math on how much passive and active money will flow into India and what may be the impact on the economy. Joining me to analyze precisely that is Shantanu Sedgupta, the economist at Goldman Sachs India, and Rajeev Radhakrishnan, the head of fixed income, head of debt at SBI Mutual Fund. Gentlemen, thank you very much indeed for joining me. Shantanu, to you first. What's the math at Goldman Sachs? How much are you all expecting in terms of flows?
Yeah, so we are estimating that the inclusion could prompt passive inflows of around $30 billion. This comprises of both EM local dedicated funds as well as the blended funds. This will be over the scaling period and as a one-off stock adjustment. Now, that's the passive part. Now, given India's attractiveness in terms of both carry, which is yields, and the low vol, both in rates as well as a low vol currency, we think that this could attract at least another $10 billion in terms of active flows through overweight positioning, off-win index flows from the crossover funds or total return funds, etc. So all of that put together, this could mean about $40 billion of inflows just from this over the next year and a half, where the phasing period will be completed by March 25.
Okay. I read through your Asia report, and you all are not very confident that, I mean, FTSE, you say the inclusion is not possible because they want A+ in terms of sovereign rating, but you're more hopeful of Bloomberg Barclays inclusion. Rajeev, where do you all stand? Are you also agreeing to this $40 billion of inflows? And where do you stand on likely inclusion in the Bloomberg Barclays index?
Yeah, on the first part, you have a range of estimates with respect to how much flows could potentially come into India post this announcement. Now, the range is anywhere between 24 to 40. But I think what one needs to understand here is the numbers are taken from the broader, the 10% weighting that India is likely to attain over the inclusion period and the overall indexed AUM at this point in time. But I think within that, we're not really sure to what extent we have pure tracker funds, which effectively will have to go with the index weighting, and to what extent are the active funds, which would have some benchmarking to this particular index. So it's very difficult at this point to hazard a real guess as to what would be the exact amount that would come in over this inclusion period. But I would still go with this range of 24-25 billion purely from the JP Morgan inclusion perspective. And on the other side, the other question was with respect to the FTSE index inclusion. So from what I understand, there are broadly two indices. One is the emerging market index, wherein I think there is a review which is due by end of this month. It's quite possible that you might get a positive announcement on that, but I don't think the index or the AUM that tracks that particular index is very large at this point. The larger one is the global aggregate index, wherein the sovereign rating becomes a constraint for India. So we will not get into that index at this point in time. But hopefully, if not in this review, maybe in the next review, FTSE might probably look at adding India in the EM index.
Bloomberg Barclays, I think that is the bigger one, Rajeev. That if we are included, and we should, I mean, in your house view, do you stand a chance there?
Sorry, in the bigger one?
The Bloomberg Barclays index.
Oh, yeah. Okay. That is possible, but we really don't have a view on that. Given that, from what we understand, the criteria is broadly similar, maybe this could happen.
Okay. But Shantanu, why are you all... You said that's not your base case in your note. Why? I mean, I thought people were expecting that inclusion.
No, so I think what we are saying is that the FTSE WGBI has the credit rating requirement, therefore that really at this stage it cannot be included. The main obstacles to India getting included in the global ag index is still market access operations, etc. Now, if GBIM has gone through, despite nothing having changed really on market access or operations, because the FAR bonds were there last year as well, if that was to be included, then hypothetically we think that this could attract another 15 odd billion dollars of flow. So if you go through with then GBIM passive plus active plus Bloomberg Global Ag, in that blue sky scenario, you could get anywhere close to 50 to 60 billion dollars of inflows over the course of the next year and a half.
Yeah, I guess the bulls are arguing that if the market access is okay for whatever 216 billion or thereabouts of passive funds tracking the JPM indexes, why would they not? Why would that market access not satisfy Bloomberg Barclays? Okay, maybe we should get Barclays themselves to speak about this. But Rajeev, now for the wheels on the ground. What are you all expecting in the quarter that's just coming up, October-December quarter? And what are you expecting in terms of the 10-year for the next 4 quarters, calendar 24?
Right. So if it's in terms of the flows that could come in, it's very difficult to sort of estimate at this point whether, when we look at over the last 5-6 months or maybe calendar year to date, we've already seen a reasonable amount of flows that have come into the FIR securities. I think that's the reason why, and to an extent, it was there in the price. So our yields have not reacted adversely to a lot of adverse external developments, and we've been held up in a broad range. I think when you get into the second half, one significant change that we will see compared to the first half would be the net supply, right? Compared to what the market had to absorb in H1, the total amount of net bond supply, the government security issuance that the market needs to absorb is substantially lower. So to that extent, I think that should provide a broad supportive range for the benchmark. But I think we need to see it in context of where the other macro parameters are.
No, give me a range. Give me a range. Give me a number that you're currently working with.
Are you talking on the benchmark?
Yes, benchmark, 10-year.
Yeah, so I would say that in the near term, probably we would be in a 10-15 basis points range from where we are trading today. So we're not likely to see a large sell-off, given that there are these supporting
No, so what,
factors.
705 to 720? No, give me numbers. We wouldn't be able to. 705 to 720 in the upcoming quarter. And the fourth
probably
quarter?
About, 730.
Fourth quarter, do we go below 6, below 7?
I don't see that happening.
Okay, so 7 would be your base case. Now, Santanu, I want the economic impact more from you. In the year to come, after all, this is a one-shot movement, as your note repeatedly says. It's a stock inclusion. Do you think that makes for better ability for the government to spend? I mean, you can dare to have a slightly higher, current 5.9 can be reduced to 5.7 and we can get away with it because we have a huge buying, and therefore is that positive on growth? Give me your impact on deficit and growth for calendar 24 or FY25.
Yeah, so we actually think that for this year, especially getting into the second half, you've had 2 shocks, right? One is the oil shock, 2 is the food shock. Both of them supply shocks. Clients have been worried that this will pass on into inflation. Our pushback has been that this getting into an election year will completely get absorbed on the fiscal balances. Hence, we are looking at about 40-50 basis points of expenditure reallocation at this stage required on food, oil, and rural transfers. Our base case right now is that the government, which has shown their commitment to fiscal consolidation, stick to around that 5.9% of GDP fiscal deficit. So absent that, you would have had expenditure higher by 40-50 basis points. We think that there's going to be a reallocation coming through in terms of expenditure such that they're able to spend more on transfer payments and subsidies and yet keep the fiscal deficit at 5.9% of GDP. In the current quarter, we are a little more bearish on growth. We think it'll be in the 5% kind of handle, given the weather-related shocks that you've seen. Next quarter, we think it's going to be better, going above 6% and then settling around that 6% kind of mark for the rest of the year. We haven't made any changes to growth forecasts because of the fiscal reallocation that we are estimating.
My question is a bit broader than that and a bit longer term. Maybe you all have not thought through this because I'm speaking about FY25. The fisc has a little more money to spend. The cost of capital is going to come down. It will probably come down for corporates as well. I mean, this is a big thing, some $50-60 billion coming in. So would you want to tinker with, or at least give a positive bias to FY25 growth?
No, I think the question is whether the government really wants to have a higher fiscal deficit just because that supply will be passed in 1 year or not. Ultimately, remember, the fiscal consolidation path is for the government to hit 4.5% of GDP over the next couple of years, which means that if you were not to consolidate next year and then go in for a very sharp consolidation the year after, you'll have a tremendous negative impulse on growth. So, any macro strategy would then suggest that, you sort of taper your consolidation towards 4.5% spread over the period of time rather than concentrating all of that in 1 year. In terms of the incremental demand coming into the system, we think that is the space for RBI to be given up. So the RBI has been, let's say, buying bonds over the last 3 or 4 years. It'll probably be the time when they are giving up on their buying and FIIs come in, or if the investment cycle was to really pick up, and banks found it better to go out in the loan market and make use of funds there, then that is where the foreigners' FII inflows are offsetting, rather than thinking of this as an increase in fiscal deficit just because they have incremental demand.
No,
so
that's fair.
The way
okay, fair point. That's a fair point, Shantanu. But if cost of capital is lower for corporates because they are ultimately benchmarked to sovereign, is not that a growth pep for the, at least 1 year FY25?
Yeah, absolutely. So, if you think about your saving investment identity and then funding the current account deficit over the medium term, this just makes it easier for you to fund the current account deficit, because now domestic savings can be channelized better in the economy if you do have an investment cycle. But remember, even without the foreigners participating in the domestic bond market and the government having this kind of supply, 10-year bond yields have been in the region of 7.25 plus minus. So it's not like without the foreign inflow of capital, you had a booming cycle which required a lot of, and therefore the government was really crowding out your investment at this stage. If you want to grow faster, I think the point is this, that if you want to grow faster, this inflow of $40 billion will help you grow faster without getting into macro imbalances in terms of either the current account blowing up and then currency having to adjust, or your 10-year bond yield having to adjust because of lower demand.
Okay, maybe I kind of eloped with my enthusiasm. The point is that you can better finance fiscal deficit and current account deficit. Cost of capital falls a bit. I was wondering if all this is a magic for higher growth. But as you correctly point out, if there is growth, then this is better financed. But ultimately, growth will depend on how well demand shapes up. And for that, of course, inflows is not the point where we should be looking at. Thank you very much, Shantanu. Unfortunately, we couldn't get the last views from Rajeev. We lost connection with him. But this discussion will continue. Thank you very much for joining us. We will meet again when the Reserve Bank announces its policy. Wrap up on Bazaar on that note. Chartbusters up next.